Hello everyone, good afternoon and welcome to AAA's Revision Revolution. Now we are going to do a mock paper. Okay, yesterday we finished the 4 section B questions and now we are going to start a full-fledged mock. This is the mock. As I told you, section A will be a 50-mark question, one question of 50 mark, and section B is going to be a 25 mark and 225 markers. So that again makes it 50 marks. As I told you on the first day that there will be 20 marks of professional since last year, but these question papers are before that. So they are not updated to that. So the actual content will be only for 80 marks and professional marks will be for 20 marks. So that is the only difference that we have in this paper and the paper that we're going to do in the exam. So, like we always do, first go to the end of the question. Pretty big question, which is a good thing. More the information, more better you will be able to write. The question gets over here and the requirement is given here if you have observed in Exhibit A. So this is like an email from the audit engagement partner and you have to answer this email. So let's see what's there in Exhibit 1. Exhibit 1, email from audit engagement partner to audit manager from Maya Crack, audit engagement partner, subject audit planning for the Eagle Group. Hello, I have provided you with some information in the form of number of exhibits you should use in planning the audit of Eagle Company. Now we just saw there are so many exhibits there. I had a meeting yesterday with the group finance director and representatives from the group audit committee and we discussed a number of issues which will impact on the audit planning. Acha, theek hai. That is what we just saw. Using the information provided, I require you to prepare briefing notes for my use in which you evaluate the audit risk to be considered in planning the audit of the group. तो हमको उसको audit risk बताने हैं. You should use analytical procedures. Now what are analytical procedures? Analytical procedures are analyzing information between last year and this year or between our company and a similar company, and based on that ratios, based on the ratios of this year and last year, you analyze a trend and then you comment on the trends. So for that we need to find out ratios, various ratios that we can find. You are not required to consider audit risk relating to disclosure as these will be planned for later in the audit process. Design the principal audit procedures to be used in the audit of the goodwill arising on the acquisition of Link's company. Management's calculation of the goodwill is shown in Exhibit 4. Okay. You do not need to consider the procedures relating to impairment testing or to foreign currency retranslation as this will be planned later in the audit. Using the information provided in Exhibit 5, evaluate the extract of the audit strategy prepared by Vulture Associates in respect of their audit of Link's company and discuss any implications for the group audit. After considering the request in Exhibit 2 from the group finance director in respect of our firm providing advice on the group's integrated report, discuss the ethical and professional implications of the request, recommending any further actions that should be taken by our firm. Thank you. 40 and 6. This becomes a 50 marker, a complete 50 marker. But for that we need to read the question once. So let's read the question and then start. You are a manager in the audit department of Bisson and Company, a firm of chartered certified accountants, responsible for the audit of the Eagle Group, the group which has financial year ending 31 December 2008. Your firm is appointed to audit the parent company, Eagle Company and all of its subsidiaries, with the exception of Lynx Company, a newly acquired subsidiary located in a foreign country, which is audited by a local firm of auditors, Vulture Associates. All companies in the group report using the IFRS standard as applicable financial reporting framework and have the same financial year end. You are provided with the following exhibits. The first exhibit, the one we read, is an email which you have received from Maya Crack, the audit engagement partner. So in that email, they have told you what all requirements are required by them. So that email is about all the requirements. There are total 5 exhibits. Second exhibit tells you the background information about the group, including a request from Group Finance Director in respect of non-audit engagement. In the first exhibit, there's an email which contains requirements. In second exhibit, there's a background information of the group and request from the Group Finance Director. Then there's a third exhibit which has extracts from the group's financial statements projected to 31 December 2008 and comparatives extracted from the management accounts and accompanying explanatory notes. In the fourth exhibit, you have management's determination of goodwill arising on acquisition of Lynx Company. And in the fifth one, you have an extract from the audit strategy document prepared by Vulture Associates relating to Lynx Company. And your requirement states, respond to the instructions in the email from the audit engagement partner. We have already seen what is there in the email. We have already read the instructions in the email. The split of the mark allocation is shown in the email and professional marks will be 4. That makes it total 50 mark question. Now 50 marks into 1.8 minutes will give you 90 minutes, which is 1.5 hours. But since we are discussing and doing it in the class, it might take more than that. So the first exhibit is read by us, which has all the requirements. Let's read exhibit 2, background information about the group and request from Group Finance Director. So we have an entire idea of the question. Group operational activities. The group, which is a listed entity, operates in distribution, supply chain and logistics management. Its operations are worldwide, spanning more than 200 countries. The group's strategy is to strengthen its market share and grow revenue in a sustainable manner by expansion into engineering markets. There are over 50 subsidiaries in the group, many of which are international. There are 3 main business divisions: post and parcel delivery, commercial, freight and supply chain management, each of which historically has provided approximately 1/3 of the group's revenue. A 4th business division, which focuses purely on providing distribution channels for the oil and coal sector, was established 2 years ago and in 2008 began to grow quite rapidly. It is forecast to provide 12% of the group's revenue this year, growing to 15% in 20x9. This division is performing particularly well in developing economies. In recent years, revenue has grown steadily, based mainly on growth in some locations where e-commerce is rapidly developing. This year, revenue is projected to decline slightly, which the group attributes to increased competition as a new distribution company has taken some of the group's market share in a number of countries. However, the group management team is confident that this is a short-term drop in revenue and forecast a return to growth in 20x9. Then innovation. The group has invested in automating its warehousing facilities, and while it still employs more than 250,000 staff, many manual warehouse jobs are now performed by robots. So that is the innovation that they have in store. Approximately 5,000 staff were made redundant early in this financial year due to automation of their work. Other innovations include increased use of automated loading and unloading of vehicles and improvements in the technology used to monitor and manage inventory levels. Integrated reporting. The group is proud of this innovation and is keen to highlight these technological developments in its integrated report. The group finance director has been asked to lead a project tasked with producing the group's first integrated report. The finance director has sent the following request to the audit engagement partner for the integrated report. We would like your firm to assist us in developing our integrated report and to provide assurance on it, as we believe this will enhance the credibility of the information it contains. Specifically, we would like your input. We would like your input into the choice of key performance indicators, that is the KPIs, which should be presented, how to present them, and how they should be reconciled where relevant to financial information from the audited financial statements. The publication of an integrated report is not a requirement in the jurisdiction in which the group is headquartered, but there is a growing pressure from stakeholders for an integrated report to be produced by listing reporting entities. If Bisson and Company accepts the engagement in relation to the group's integrated report, the work would be performed by a team separate from the audit team. So this is the Exhibit 3, which has extracts from consolidated financial statement and statement of financial position. You have goodwill, other intangible assets, all of them. Then you have current assets, and you have total equity, then you have statement of P&L also. Okay, this is a statement of P&L. Now notes to the extracts from the financial statements are available, wherein goodwill says goodwill relates to the group's subsidiaries and it is tested for impairment on an annual basis. Management will conduct the impairment review in December 20x8, but is anticipated that no impairment will need to be recognized this year due to anticipated growth in revenue, which is forecast for the next 2 years. In March 20x8, the group acquired an 80% controlling shareholding in Links Company, a listed company located in a foreign country, for consideration of $351 million. Management's determination of goodwill arising on acquisition is showed in Exhibit 4. Other intangible assets. Other intangible assets relate mostly to software and other technological development costs. During the year, $35 million was spent on developing a new IT system for dealing with customer inquiries and processing customer orders. A further $20 million was spent on research and development into robots being used in warehouse and $5 million on developing new accounting software. These costs have been capitalized as intangible assets and are being amortized over a 15-year useful life. Equity and non-current liabilities. A share issue in July 20x8 raised cash of $100 million, which was used to fund capital expenditure. Non-current liabilities including borrowings of $550 million, last year it was $500, and provisions of $100, last year it was $120. Changes in financing during the year have impacted on the group's weighted average cost of capital. Information from the group's treasury management team suggests that the weighted average cost of capital is currently 10%. Financial performance. Revenue has decreased by 3.7% over the year due to the new competitor in the market taking some of the group's market share. Other operating income comprises of all of these. Then operating expenses is these. the operating expenses. And this is Exhibit 4, determination of goodwill on acquisition of links. These are the notes for determination of goodwill. So when we do that, we'll read it. Extract 5. Extract for audit strategy prepared by Vulture Associates in respect of the audit of Links Company. The 2 points below are an extract from the audit strategy. Other sections of the audit strategy include the audit strategy assessment, have been reviewed by the group audit team, and are considered to be satisfactory. Links Company is projected to be loss-making this year, and the group audit team is confident that sufficient procedures and going concern have been planned for control effectiveness. We will place reliance on internal controls which will reduce the amount of substantive testing which needs to be performed. This is justified on the grounds that in the previous year's audit, controls were tested and found to be highly effective. We do not plan to retest the controls as, according to the management, there have been no changes in systems or the control environment during the year. Internal audit. Links Company has offered the services of its internal audit team to help perform audit procedures. We are planning to use the internal auditors to complete the audit work in respect of trade receivables, as they have performed work on this area during the year. It will be efficient for them to perform and conclude on the relevant audit procedures, including the trade receivable circularization and evaluation of the allowance for trade receivables, which will instruct them to carry out. So now look at requirement A. Which says evaluate the audit risk to be considered in planning the group audit. You should use analytical procedures to assist in identifying audit risk. You are not required to consider audit risk relating to disclosure, as this will be planned later in the. Basically, you have to give the audit risk by using the analytical procedures. For that, you have to find out ratios. So this is question 1A. Let's begin with that. What is this? You have to prepare it like an email only. So they have sent an email to you. You also have to reply like an email. So write down briefing notes. To Maya Craig, audit engagement partner, right? From audit manager, subject Eagle Group, audit planning, and introduction. So first I'll give the introduction and then I'll start with the A part. So what is the introduction? The introduction will say these briefing notes are prepared to assist with planning the audit of the Eagle Group for the financial year ending 31 December 20x8. The notes contain an evaluation of the audit risk which should be considered in planning the group audit. The notes also recommend the principal audit procedures to be used in the audit of goodwill which has arisen in respect of a newly acquired subsidiary. Finally, the group finance director. So this is going to give you an introduction of all the requirements that they have asked. The group finance director has requested our firm to provide a non-audit service. Which one is that? In relation to the group's integrated report. And the notes discuss the professional and ethical implications of this request. This is the entire introduction of the email that is going to go. Now from that, the first one is evaluation of audit risk using analytical procedures. So for that, you have to first find out the ratios. So selected analytical procedures and associated audit risk evaluation. Okay, so for both the years you have to find out 20x8 and 20x7, which is last year. So 20x8 and first thing you have to do is go to the question and see what all ratios you can find. So from this we can find the operating margin, because we have the operating profit, so operating margin ratio. From all this we can find ROCE, return on capital employed. You can find the current ratio, current assets divided by current liabilities. You can find a debt equity ratio, right? What else you can find out? We can find out a debt equity ratio, interest cover, because we have finance charges. Then we have tax expense, so we can find out effective tax rate. What else? That's it. So let's find out the ratio. First we can do is operating margin. Then I told you we can do is ROCE, which is return on capital employed. Then I told you we can do is current ratio. Then we can do is debt upon equity ratio. Then we can do is interest cover ratio. Then we can do is effective tax rate ratio. So now I'll orally tell the ratios to you. You have to quickly find out and write it down. Operating margin ratio is operating profit divided by revenue into 100. Return on capital employed is the return that you have earned from capital employed. So the capital employed will be this 2245 capital employed plus 650. That is total equity plus non-current liabilities. That will be the denominator. And the numerator will be the return that you have earned from them. That is 350 operating profit. So 350 divided by 2245 plus 650. Similarly for the previous year. Then current ratio will be current assets upon current liabilities. So current assets is 1450. Current liabilities is 597. Debt upon equity ratio is debt is 539 and equity is 2245. So that is debt equity ratio. Interest cover ratio is the interest. Interest is a finance. Interest is 28. Interest is a finance charge, is 28, and interest cover to profit. So 350 divided by 28, and effective tax rate is tax expense 64 divided by 322. That is profit before tax. So that will give you the operating margin to be Guys, please calculate, because and then write it down. 6.1%, and for the previous year it is 4.5%. Then ROCE for 20x8 is 12.1%. Then for this it is 10%. Then current ratio, here it is 2.4, and here it is 2.6. Then debt upon equity, here is 24%, and here it is 23.9%. Then interest cover, here it is 12.5, and here it is 9. And then effective tax rate ratio, here it is 19.9%, and here it is 25%. Okay. Now you have to comment on each. So first I'll comment on operating margin and operating expenses. What will you say about that? The group's operating margin has increased from 4.5% to 6.1. Despite a fall in revenue, if you observe, there is a fall in revenue from 5990 to 5770. So if you calculate the percentage fall, that is the difference divided by 5990, you will get fall in revenue of 3.7%. This is due to the reduction in the operating expenses. Of 4.5% and increase in other operating expenses. Increase in other operating income of and other operating income का increase देखो, the difference of the two divided by 80 will give you 50%. ROCE, that is return on capital employed, shows a similar positive trend. Despite the fall in revenue, there is an audit risk that expenses are understated with the reduction in expenses being proportionately then reduction in revenue, then within operating expenses, the trend for each component are different. So if you see in operating expenses is there in 7, so go to 7. Trend for each item is different. Staff cost is different. This is increasing, this is reducing, this is increasing, this is increasing, this is reducing like a lot. Okay, so उनका percentage निकाल दो. Difference divided by this number will give you the percentage increase or decrease. So with operating expenses, the trend for each component are different, like cost of raw materials, consumables, this one, cost of raw materials, consumables, and supplies has decreased, right? Decreased by how much? 3.1%, which appears reasonable given the decline in revenue. However, पहले ही सब कैलकुलेट करके रखो ये लिखने से पहले. तो मेरा कैलकुलेशन रेडी है इसलिए मैं लिख रही हूँ. आपको मैंने मेथड दिया है कैलकुलेट करने का. द डिफरेंस फॉर एग्जांपल 1780 माइनस 1725 डिवाइडेड बाय 1780 इंटू 100, सो उसको 3.1 आएगा. दैट इज़ द डिक्रीज. वैसे however, staff costs have increased slightly by 1.1%, which seems inconsistent with the revenue trend and with the increased automation of operations, which has led to 5,000 staff being redundant, right? Because of robots. Which presumably means less payroll cost this year. Expenses could have been misclassified into staff cost in error. Okay. Then about depreciation, amortization and impairment. This one. Has increased by 3.6%. which is not a significant change. What will need to be investigated. To consider. How each element of the category has changed in the year. And the most noticeable trend, according to me, is this one. Other operating expenses from 270 direct 20. So the most noticeable trend within operating expenses is that the other operating expenses category has reduced very significantly. The amount recognized in the FS is only 7.4% of amount recognized in the last year. And this appears totally inconsistent with other trends noted. Then for other operating income, go to other operating income. This is other operating income. See the trends in other operating income and already calculate and keep the differences. So write about this now. There is also an audit risk that other operating income give me 1 minute. So other operating income is overstated. According to the information during the year, a credit of 60 million has been recognized in profit Reversal of provisions. This is 50% greater if you calculate. Then the amount recognized in the previous year. In addition, 30 million. Basically what you have to do in this is you have to just compare this year with last year, the increase or decrease percentage you have to calculate, and you have to give your view on that. So in addition, 30 million has been recognized for reversal of impairment losses. There is a risk that these figures have been manipulated in order to boost profits as an earnings management technique. In reaction to the fall in revenue in the year. The risk of management bias is high given the listed status of the group. Hence, expectations from shareholders for positive growth trend. The profit recognized on asset disposal and increase in foreign currency gains could also be an indication attempts to boost operating profit this year. Okay. Then next you can say about current ratio and gearing. For that, see the current ratio and gearing that you have calculated. Current ratio has reduced, gearing has increased. So what can you say about current ratio and gearing? Looking at the other ratios, the current ratio and gearing ratio do not indicate, because it's changing only slight, audit risk. However, more detail is needed to fully conclude the liquidity and solvency position of the group, and whether there are any hidden trends which are obscured by the high level analysis which has been performed with the information provided. Then next, what we can talk about, the interest cover has increased due to both increase in operating profit and the reduction in finance charges. This seems contradictory to the increase in borrowings. And as a result, of this, an increase in finance charges would be expected. There is an audit risk that finance charges are understated. This is regarding current ratio and carry. Then effective tax rate. The effective tax rate has fallen from 25% to 19.9%. And audit risk arises in that the tax expense and associated liability could be understated. This could indicate management bias, as the FS, that is financial statement, suggests that the accounting profit has increased. Then what is given in the B part of the exhibit? in measuring goodwill on the acquisition of initial measurement of goodwill on the acquisition of links. So the second part, I've just given you the pointers. You have to elaborate and write it more. So the B part is principal audit procedures on the goodwill arising on the acquisition of a new subsidiary, that is Links Company. Now before we start this, we'll take a break of 5 minutes. So the first one of this would be what you can do. Obtain the legal documentation pertaining to the acquisition and review to confirm that the figures included in the goodwill calculation relating to consideration paid and payable are accurate and complete. In particular, confirm the targets to be used as the basis for payment of the contingent consideration in 4 years time. Okay. Then also confirm from the purchase documentation that the group has obtained an 80% control after it has acquired new shares, shareholding, and that this conveys control, that is, the shares carry voting rights and there is no restriction on the group exercising their control over Wings company. Then agree the 80 million paid to the bank, statement of cash book, of the acquiring company. Then your favorite review board minutes for discussion relating to the acquisition and for the relevant minute of board approval. And for contingent consideration obtain management's calculation of the present value and evaluate the assumptions used in the calculation. One last point we can give is review the calculation of net assets required to confirm that group accounting policies have been applied. Okay. Next one, if you see, using the information provided in Exhibit 5, evaluate the extract of audit strategy prepared by Vulture Associates in respect of their audit of Link's company and discuss any implications for the group audit. So go to Exhibit 5. And depending on this, you have to answer depending on the strategy. So when you read this, we have already read it. This is the C part. Evaluation of the extract of the audit strategy prepared by Vulture Associates in respect of their audit Link's. Okay, so what they have said, the extract from the audit strategy covers two areas. What are the two areas? Control effectiveness and internal audit. Reliance on internal controls and the valuation of the company's pension plan. It appears that IIC requirements and ethical principles have not been followed, meaning that the quality of the audit planned by Vulture Associates is in doubt. Okay. First one we have is control effectiveness. In in relation to the reliance of internal controls, or rather the reliance on internal controls in relation to relying on work performed during previous audits on internal controls states that if the auditor plans to use audit evidence from previous audit about the operating effectiveness of specific controls, the auditor shall establish the continuing relevance of that evidence by obtaining audit evidence about whether significant changes in those controls have occurred subsequent to the previous audit. The auditor shall obtain this evidence by performing inquiry combined with observation or inspection to confirm the understanding of those specific controls and if there have been changes which affect the continuing relevance of the audit evidence from the previous audit, the auditor shall test controls in the current audit. Then, if there have not been such changes, the auditor shall test the controls at least once every third audit. They are not testing at all, but at least once every third audit. They are directly trusting the management and shall test some controls each audit to avoid the possibility controls on which the auditor intends to rely on a single audit period with no testing of controls in the subsequent 2 audit periods. Okay. That is the control effectiveness. Then what would be your closing statement? The group audit team should discuss the issue with Berkshire Associates to ensure that adequate testing is performed. If for some reason Berkshire Associates does not amend its audit strategy, then the group audit team may decide to perform additional testing, given that Link's company is material to the group. This is what you can write about the C part. Now there's a D part to it in the email, which says, after considering the request in Exhibit 2 from the Group Finance Director in respect of a firm providing advice on the group's integrated report, discuss the ethical and professional implications recommend any further actions that should be taken by the firm. So this is like a non-audit service. That's a request from Exhibit 2. Assist in developing integrated report is a non-audit service. So write down the next one. D. This is ethical and professional implications of the request to provide or non-audit service on the group's integrated report. are several issues to consider with regard to providing this service. Okay. A significant issue relates to auditor objectivity. The ethical standards for auditing provides requirements and guidance on situations where the auditor is asked by the client to provide non-assurance services. Bisson and Company needs to evaluate the significance of the threat and consider whether any safeguards can reduce the threat to an acceptable level. Now once you read it and see what points you can write, read the exhibit. Till then I'll quickly check the comments. We begin. About integrated reporting. Ethical and professional implications of the request to provide non-audit services on the group's integrated report. So what will you do first? While the integrated report is not part of the audited financial statements, the report will contain financial KPIs. What is KPIs? Key performance indicators. And the group has asked for input specifically relating to the reconciliations between these KPIs and financial information contained in the financial statements. There is therefore potential self-review thread, because I'm only making the integrated report and I'm only going to check it. So that's a self-review thread, right? Objectivity. In that the audit firm has been asked to provide assurance on these KPIs which are related to figures which have been subject to external audit by the firm. The team performing the work will be reluctant to raise queries or highlight errors which have been made during the external audit when assessing the reconciliations of KPIs to audited financial information. It could also be perceived that Bisson and company is taking on management responsibility by helping to determine content to be included in the integrated report, which is a threat to objectivity. The audit firm should not assume management responsibility for an audit client where the threats created are so significant that safeguards cannot reduce them to an acceptable level, while the ethical standard does not specifically state that helping the client to determine the content of its integrated report is taking on management responsibility. Certainly, there could be that perception as the auditor will be involved in setting measurements which the company will benchmark itself against. Additionally, working with management on integrated report could create a familiarity threat to objectivity, whereby close working relationships are formed and the auditor becomes closely aligned with the views of management and is unable to approach the work with an appropriate degree of professional skepticism. Okay. Then what else can you write? Finally, given that the group is a listed entity, comply with the requirements of the UK Corporate Governance Code. As applied in Ireland, the audit committee should apply the group's policy on engagement of the external auditor to support non-audit services. The objective of which should be to ensure that the what will you do? Provisions of such services does not impair the external auditor's independence or objectivity. The group's audit committee will need to pre-approve the provision of the service, and in making the decision, or rather this decision, they should consider a number of matters. Like skills, experience, etc. Okay, so this is done. Now the main conclusion. So the entire question is like an email, so you have to give a conclusion on the entire email. Okay, so what conclusion will you give? This briefing notes indicate that there are large number of audit risks to be considered in planning the audit, and the management needs to supply the audit team with a range of additional information for more thorough audit planning to be carried out. The audit of goodwill, and in particular the goodwill arising on the acquisition Links company is an area of significant audit risk and the notes recommend the principal audit procedures which should be conducted an evaluation of the audit strategy prepared by Vulture Associates indicates that their audit of Links company might not be a high quality audit and that there is a threat to audit objectivity. These issues need to be considered in developing the group audit strategy. Finally, our firm needs to discuss the request to assist preparing the group's integrated report with the group audit committee, and it seems unlikely given the threat to management involvement that we would be able to carry out work for the group. So these are the pointers. You have to elaborate it more and write down. If you can elaborate more, well and good, otherwise whatever. Then the second one we have is this one. So now I want you to read the requirement and read this question. Before we start the second one, we take a break of 5 minutes. So again, we're going to start with reading the requirement first. Recommend and explain the matters which should be discussed with management in relation to each of the proposed adjustments, including an assessment of their individual impact on the financial statements and on the auditor's opinion if management does not make the proposed adjustment. And the split of mark allocation is shown against each of the issues. For every issue, you have to state the individual impact on the financial statement and on the auditor's opinion if management does not make the proposed adjustment. So the first issue is this lease testing equipment. This is the first issue, which is for 7 marks. Then second one is legal claim for 5 marks, and third one is asset impairment. So let's see the question from start. This is a 25 marker question. Section B, first question. You are an audit manager in Coram and Company, a firm of chartered certified accountants. The audit of one of your clients, Clark Company, for the year ended 31 May 2018 is nearly complete, and the auditor's report is due to be issued next week. Clark Company is an unlisted family-owned business which specializes in the service and repair of both commercial and privately owned motor vehicles. The company operates from 7 geographical distinct sites, each of which is considered a separate cash-generating unit for impairment review purpose. The draft financial statements recognize profit before taxation for the year of $2.3 million and total assets of $22 million. The schedule of uncorrected misstatements included in Clark Company's audit working papers and prepared by the audit supervisor is shown below. You are due to attend a meeting with the finance director of Clark Company tomorrow, at which the uncorrected misstatements will be discussed. This is the schedule of uncorrected misstatement. Every uncorrected misstatement is stated here. Lease liability, lease asset, contingent asset, provision for liability asset expenses, and the totals of them. Lease testing equipment पहले तो. In the jurisdiction in which Clark Company operates, all motor vehicles over 3 years old are required to undergo an annual test of vehicle safety and roadworthiness. The annual test requires specialist testing equipment which is inspected by government officials on a regular basis. Following inspection visits in May 2018, the government inspection report required Clark Company to replace the testing equipment at 3 of its sites. In order to comply with this requirement, Clark Company has agreed to lease new testing equipment from a leasing company on a 6-month lease under the terms of the lease. The company has no option to purchase the equipment. The testing equipment was made available for use by Clark Company at each of the 3 sites on 31 May 2018. The client has capitalized leases with a total carrying amount of $625,000 and 2 of the sites but has elected to take advantage of the IFRS 16 leases exemption not to capitalize short-term leases at the largest of the 3 sites. As a result, the present value of the lease payments of $475,000 relating to the site has not been recognized on the company's statement of financial position. So first one is lease testing equipment. Okay. What can you write regarding the lease testing equipment? First of all, check the materiality of that. It has a carrying amount of 625 in relation to the total assets, and this thing you have to check. Then after checking that, you write the lease at Clark Limited largest site is material to the statement of financial position at how much percent of total assets it is? It's 2.2% of total assets. The leases at the other two sites are, check their materiality also material at 2.8% of total assets. Okay. The general recognition and measurement requirements of IFRS 16 leases requires lessees to recognize or right of use asset and a lease liability at the commencement date of the lease at the PV, that is present value of the lease payment. The standard defines the commencement date as the date the asset will be available for use by the lessee. Given that the commencement date is 31 May 20x8, therefore it is appropriate on this basis to recognize the lease on the statement of financial position as at this date. Okay, it is significant, however, that IFRS 16, that is leases, also contains an optional exemption for short-term leases for less than 12 months, right? If you studied SBR before this, you will know what leases say. With no purchase option. If Clark Company elects to apply this exemption, it does not recognize the leased asset or lease liability on statement of financial position, but rather it recognizes the lease payment associated with those leases as an expense in the statement of P&L for the year, either on straight line basis over the lease term or on the systematic basis. However, IFRS 16 also requires that if this exemption is taken, it must be applied consistently. By each class of underlying asset. Hence, in this case, the client must either capitalize the lease across all three of the sites or apply the exemption consistently and not capitalize the lease across any of the sites. On either of these bases as the commencement date of the lease coincides with the reporting date there would not yet be any impact on Clark Limited's statement of P&L for the year. The audit manager should discuss the option of taking the short-term lease exemption with the finance director tomorrow's meeting. What will it say? If the client decides not to take exemption, just the three sides. Assets and liabilities will be materially understated. Hence, the audit supervisor proposed adjustment is correct, and right of use asset and lease liability should be recognized in the statement of financial position. Alternatively, if the client does elect to take the exemption across all three sides, then assets and liabilities are materially overstated, and right of use asset and lease liability should be derecognized in statement of financial position. Then what else? Impact on audit opinion. How will the auditor change his opinion if the client does not make adjustment? So if the client does not make any adjustment to FS, the statement of financial position is materially misstated on the basis of misapplication of an accounting standard and the audit opinion should be qualified on the basis within except for okay. So this should be your answer for the first category, which is lease of testing equipment. Okay, so that's the first category that we have, and we have to give an answer that if the auditor does not check the financial statements, if the auditor does not make the necessary changes, then what can be your opinion? So that is the first category, which is solved and which was for 7 marks. The second one we have is a legal claim. Now I want you to go through the legal claim and then we'll continue. The second one we have is a legal claim. What do we do in terms of legal claim? First, read the legal claim. It is 5 marks. Okay. A customer of Clark Company successfully sued the company for negligence in April 2008 after suffering a personal injury at one of its sites. The court awarded the customer $1.2 million in damages, and this had not yet been paid, as at 31 May 2008. The audit working papers include a copy of a verified letter dated 25th May 2008 from an insurance company confirming that the claim is fully covered under the Clark Company's public liability insurance policy on the basis that the company has no net liability as a result of the claim. The finance director has not recognized any amounts in the financial statements and has not made any disclosures in relation to the matter. Now for the legal claim. Again, first check if the legal claim amount is material or not, and then write, because always when we have to look at the effect of that, if the management doesn't consider that, then what will be the ultimate effect all depends on materiality. So first look at the materiality of the legal claim and then write down. So the second one we have is regarding legal claim. Okay. So first find out the materiality. So legal claim is material to the statement of financial position, being 5.5% of Clark Company's total assets. Following the requirements of IS 37, which is provisions, contingent liabilities and contingent assets, or provision should be recognized when an entity has a present obligation, be it legal or constructive, as a result of a past event. It is probable that an outflow of resources embodying economic benefits will be required to settle the obligation. And a reliable estimate can be made of the amount of the obligation in this case. The customer has already won the action against the company. The amount of the claim has been agreed by the courts and settlement is still outstanding at the reporting date. Hence, a provision should be recognized on the statement of financial position. IS 37, that is provision contingent liabilities and contingent assets, also states that contingent assets are not recognized in FS, since this may result in the recognition of income which may never be realized. However, the standard continues by stating that when the realization of income is virtually certain, then the related asset is not a contingent asset. Its recognition is appropriate. With respect to Clark Limited's insurance claim, therefore, and the verified letter dated 25th May 2008, the settlement of the claim as at the reporting date is virtually certain, and an asset should be recognized separately on the statement of financial position. The audit supervisor proposed adjustment is correct, and the finance director should therefore be requested to adjust the financial statements to include the separate recognition of the assets and the provision. If the adjustment is not made, liabilities will be materially misstated. There is no net impact the statement of P&L for the year. And what else can you write on this matter? The finance director should be advised that the FS should include full disclosure of the facts and amounts surrounding the provision for legal claim together with full details of the expected of the reimbursement from the insurance company recognized as an asset. What is the impact on audit opinion? If the client does not make any adjustments to the financial statements the statement of financial position is materially misstated, and the audit opinion should be qualified on the basis of except for okay. So this is the second one, and then we have the third one to be asset impairment. So please read the asset impairment and then we'll solve it. And this is worth 5 marks, so you have to write worth 5 marks. can we begin? Okay, so the third category is the asset impairment. So let's do the asset impairment. First of all, check materiality. Is not material in isolation, that is individually, to either the statement of financial position or the statement of P&L. Now this is impairment, so for this you have to follow IAS 36. According to IAS 36, impairment of assets, an entity assess at the end of each reporting date reporting period whether there is an indication that the asset or cash generating unit may be impaired. If any such indication exists, the entity shall estimate the recoverable amount of the asset. The standard states that the potential impairment indicators include external sources of information, such as significant changes in the market in which the entity operates, as each of the Clark's Limited's sites is considered a cash generating unit for impairment review purposes. It seems appropriate, therefore, for the company to have conducted an impairment review at this particular site. And what else can you say? IAS 36 states that when the recoverable amount is more than the so when the impairment occurs, basically, so you have to explain in this part when an impairment occurs and then explain that. After that, the audit supervisors proposed adjustment is therefore correct and the finance director should be advised of this error at tomorrow's meeting, even though the amount is immaterial to both the statement of financial position and the statement of P&L for the year. It is appropriate to request that the adjustment is made to the financial statements. Impact on audit opinion. What can be the impact on audit opinion? Given that assets and profits are both immaterially overstated, no adjustments is made to FS. It follows that there will be no impact because it's immaterial on the audit opinion in relation to this matter in isolation. So this is your solution about this particular one. The next one we have is the B part, which is for 8 marks. So let's read the B part. Comment on the ethical and professional issues raised in respect of the auditor of Turner Company and recommend any actions to be taken by the audit firm. So you have to comment on the ethical and professional issues raised, and you have to comment on any actions to be taken by the audit firm. Okay. Your client portfolio as an audit manager at Quorum and Company also includes Turner Company, which is a listed financial institution offering loans and credit facilities to both commercial and retail customers. You have received an email from the audit supervisor who is currently supervising interim testing on systems and controls in relation to the audit for the year ending 31 October 2008. The email gives the following details for your consideration. One of the audit team members, Janet Stott, has provisionally agreed to take out a loan with Turner Company to finance the purchase of a domestic residence. The loan will be secured on the property, and the client's business manager has promised Janet that he will ensure that she gets the best deal with the bank which the bank can offer. The payroll manager at Turner Company has asked the audit supervisor if it would be possible for Quorum and Company to provide a member of staff on secondment to work in the payroll department. The payroll manager has struggled to recruit a new supervisor for the organization's main payroll system and wants to assign a qualified member of the audit firm staff for initial period of 6 months. So they have requested that somebody come and work in the audit firm for a period of 6 months. Now here and there for a period of 15 days or so is acceptable, but 6 months becomes too much. If the audit firm is appointing their own member into the client for 6 months, then there will be a self-review threat. So that will be very difficult to address. So that is going to be the answer for this, which we are going to discuss tomorrow. But that is like 6 months is a long time if you consider. If they wanted it for 15 days or so, the audit firm would have agreed to do that. But 6 months is a long time, and then it will give rise to a self-review threat, then there will be familiarity threat, and then all of that. So that problems we want to avoid. So that's it with today's live session. See you guys tomorrow so that we can complete this mock. Thank you so much for attending this live, and happy studying.